Hello and welcome to the Harwood Report for March 5th, 2018, presented by Trade Academy. I'm Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. A lot of stuff going on here in the last week, so let's get through the disclosures and then we'll get right to it. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Options have risk. Do your own due diligence. Consult with a financial advisor before executing any trade. All of this, what it's saying in a nutshell is, I'm doing this for educational purposes, informational purposes, and I'm not recommending any trades. This is just the way that I look at these markets. And so we'll go through them. The main equity indices, VIX, still a big driver, bonds, gold, and oil. We got a lot to cover, so let's just get straight to the charts. First, with the stop at fear and greed. I always start here, and it's ridiculous where fear and greed is right now. The market is not in turmoil. Yes, tariffs are a concern. What if we start a trade war? You know what? Are we pricing it in when we put fear and greed at this level? It seems to me like we're maybe pricing in the worst case scenario if this is the reaction from the market. We don't necessarily need to be pricing in the best case scenario, but do we really need to be pricing in something that's this close to the worst case scenario? You can see, vol has come off some, but where we're really getting some of this extreme fear is stock price strength. Basically, stocks making new 52-week lows instead of new 52-week highs, and some of the stuff going on with put-call ratio, people are getting their hedges on. So a lot of these hedges are happening, which means that maybe everybody's hedged now. We're pretty close to hedged. So we've had a lot of market sellers, a lot of hedges put on. Makes me a little bit more confident still that this market needs to go higher. And, it's been going this way for a couple weeks now. It's not over yet. This really started with that February 5th washout. So it's been a month of kind of extreme fear in this market. That kind of move justifies a bid in the VIX for a little bit longer. But maybe not to this extreme anymore. Maybe a lot of the stuff has gotten pulled out. So let's get straight to the charts and see what else we're seeing in the technicals. Actually, before I talk technicals here, I also want to point out that this week does have some big news events. We've got an ECB meeting. We've got the beige book from the Fed on Wednesday. That's big. Powell's conversations last week seemed to put a little bit of jitters in the market. Obviously, they're working on NAFTA right now. That's going to be related to the tariff stuff, and that could put a little bit of jitters in the market. And then Friday, we've got non-farm payrolls, and that kind of started up that February 5th collapse with the move in bond yields and everything else. So there's a lot of little pieces here that are, actually big pieces here that could create a little bit of jitters in the market. Maybe that's part of why we're seeing that big bid. But as each one of those things peels off and the unknown becomes known, even if it's not necessarily the optimal scenario, I think that helps drive implied volatility down and push the market back higher. So I'm coming in with a base of higher. Last week, 3 bad days. The 4th bad day had a lower high and a lower low, but today looks like this is, trying to make this look like a V bottom. Really, we found our support at the 100-day moving average. I think I mentioned last week, we spent a little time here at the 100-day moving average before spiking up to the 50. Spent a little time around the 50. That didn't hold. So the 100-day moving average is proving to be our support level right now. If this doesn't hold, we're looking at the 200-day moving average. If this does hold, we go and chop around here at the 275 level again and try to put enough trade around the 50-day moving average to make that the next support level. So right now, I'm looking at 275 on the upside, 256 on the downside, currently trading 270. A pullback to the 100-day moving average is a great entry point for me to look for a long position targeting 275. If we blow through here, I wouldn't be surprised, and then the 278 level becomes kind of our resistance, 279, right near this recent high. And if we blow through that, it's 285 all of a sudden. So I've got some levels that I'm watching on the upside as we drive, looking for a stall here and a stall here. And if neither of those can actually create a stall because the news that comes out from NAFTA or tariffs or the beige book or non-farm payrolls or whatever just helps put a lot of confidence into this economy again, then I'm looking for this move right back to the highs. We just have a lot of work to get there. That's why I think that there's still some of that put demand here. There's a number of levels above that can create resistance, where below there's only 2 levels for support that really matter right now. And that's the 100-day moving average and then the 200-day moving average. And that the distance between the 100-day moving average and the 200-day moving average is a lot. When I look at all of this, though, VIX is coming down. So it came up a little bit last week, obviously, with the 3-day move. Friday, it had firmed it during the initial break, broke. Today, it's looking like it wants lower. VIX back down to 15.5, 16 on the cash, makes some sense here, barring a break of the 100-day moving average. These things are going to be correlated. The VIX pressing lower is going to naturally push S&Ps higher. As people get their hedges on, there will be less demand for hedges, less demand for insurance. That allows the VIX to drop. So basically what I'm looking at right now is an expectation that the VIX will actually continue a little bit lower, along with the S&Ps higher. If the VIX gets back above the kind of this 22.5, 23 area on the cash, then it's telling us that there's something else going on. And if we really get up here, up above 27, it tells me that that people still need insurance. Not everybody got their insurance on. So then that may mean a real problem in the market. But right now, as long as VIX looks soft, I'm going to be looking for that to move down towards 16 on the cash this week. It's a decent sized break for where things are priced in. So there's something there, I think, that might help give another sort of basis for some of this trading. As that VIX falls, that gives me a lot of leverage to play for moves in the markets again via the options. I've talked a lot about IWM being sort of my preferred long because of its discount to the Qs. One of the other things that comes up is if this tariff thing happens and we get into a trade war, small caps are less exposed to it. A lot of small caps are a little bit more domestic players, where the big tech names are all global. Apple, obviously a big global player. And so maybe that little news from last week triggers a little bit of money flow into IWM and then starts to reverse that discount. Because IWM's been trading at about a $13 discount to the Qs. It spiked up over 17 late last week before this stuff came out. Traditionally, it trades closer to $5, $6, $7. And sometimes IWM even trades at a premium to the Qs. This kind of news is something that makes me want to be long IWM over any of the other ETFs for multiple reasons. Number one, it was already an extreme relative to the Qs. And number two, if this stuff actually comes through and it's not just bearish everything, then long IWM and either short or flat the Qs, whatever, makes some sense. IWM can come up $6 or $7 if Qs stay flat, or if everything rallies, maybe IWM just way outperforms to the upside and we get the NASDAQ back to 170, the Qs up to 162, 163, and SPY back towards a new all-time highs. Because where's, an $8 discount puts it, if the Qs go to 170, this goes to an $8 discount at 162, that's a new all-time high for this. So I still see a lot of upside potential in IWM. And it doesn't have as much resistance here at the 50-day. The 100-day was really the big one, and we're already through that again. So IWM is starting to show some relative strength here that makes me a little more excited there. So what I'm looking at now as a result of that is if I go to IWM and I look at the vol levels of IWM, it's not nearly as extreme as in the S&Ps. The highs here back last year were really around 16, just under. Last year, the highs in SPY vol, they were around 11. So if SPY is 15.5 and the Qs are around 16.5, and usually the IWM's trading 1.5-ish times what SPY vol is, then that's the one that's cheap. IWM and Qs vol tend to be pretty close to each other. SPY usually is about 2/3 to 3/4 of that level. So right now, IWM vol looks pretty cheap to me. I stated a reason why I could think this could go up a lot. I've got a couple of smaller trades right now. On the long side here, we're looking for vol to get hit a little bit more, but the more I think about this, the more I want to add something. It's got a little more time to expiration and some Vega here, or some Gamma here, basically. So if I look at the April 160s, maybe that's not the play because 80-cent options only go to $2 in that rally all the way to 162. Maybe we don't get that full move. But if I go a little shorter here and I look at the April 6th, vol's a little lower. And on the upside, I can look at, say, something like the 157s for $1.10. That's not too bad at 14.5 vol. 14.5 vol, as a reminder, is right around here. It's not in this extreme high level. The low where we may get down to is probably back to, I can't imagine we get back down to 12. I would think that the lowest vol is going to get back down to its 13.5 range in the near term. So if that's the case, buying a little bit of just over 14 vol isn't going to kill me. So April 6th, 157 calls, 111, 112, we'll call it. That seems like a good way for me to play for that relative strength in IWM that I expect to sort of continue here. Let's move to the bonds quickly. So bonds, during this move, everybody said that the only direction for yields was higher. So bonds had to go lower. They're pulling down a little bit right now, but when everybody becomes confident in a trade going one direction and having no chance of the other, oftentimes you get at least a dead cat bounce. We didn't get as big of a dead cat bounce as I really expected, to be honest. But I think right now the risk in TLT is to the upside. Everybody still wants to be short bonds. They want to expect this to go lower so we can squeeze out those guys, especially if non-farm payrolls don't make it look like we're going to do that extra rate hike this year, or if the beige book sounds a little bit more conservative. That sort of stuff happens. I think we can still see bonds up towards 122. I've been patient with trying to get into this stuff because of the fact that obviously it's just not moving. But bond vol at 11 is cheap. And on the upside, I mean, I'm looking back all the way to April now just to give myself some time since this is chopping right now. But I think that going into like the April 121s here at 82 cents is not that bad at 11 vol. So that's another one I'll be looking at now is the April 121 calls for 82. Looks like mid-market. They could get a little bit cheaper on vol. I mean, they were 10.6 vol last week. So they're up about 10% just on a vol basis. But time's been passing and market's chopping, and we've got some fundamental inputs this week. So I may not be able to wait for that vol to come back down if the fundamental information is coming out. All right, let me move over to gold now. So first I start with the dollar. Dollar had, I mean, it looked like it was going to break out here, and then it just rejected right here at the, 50-day moving average. So that's my trigger for the dollar, but dollar yen's really my bigger concern generally with gold. And so when I look at that, this just looks, like it should just keep going down. We're going to keep getting bounces like this probably. But if this bounces to 107, doesn't take out the 20-day moving average that's been providing some good resistance, then just keep going down, and that's going to eventually have to put some money flow into gold, especially if we also get that dead cat bounce in bonds. If rate hikes become less probable, gold increases in value. So as yields drop, gold can increase in value because it's not a yielding product. So, when you can get yield elsewhere for a safe haven asset that can also give you yield, like in bonds, then you'd rather go there traditionally. Otherwise, gold provides a nice safe haven asset, safe haven risk off trade for a lot of people. So I'm watching this for, maybe taking a shot on a dip. I'd like to see the dip happen first. Maybe back here down towards the 100-day moving average would be a great place for me to get an entry in gold. That allows the market to break, allows the bulls to get really dejected and say, gosh, we've broken through all these levels. But as long as this 100-day moving average holds, then that creates a good dip buying opportunity for me, unless dollar yen breaks out above the 20-day moving average, in which case it's just bearish, and that's not, I'm going to miss this one because there's a lot of consolidation here around 122. The alternative would be for me, if I want to try to chase the momentum, is wait for a move, back up in here, up towards the 126.5 range. So I want to get above all the key moving averages and continue to see dollar yen weakness. For me to make this play, there's a number of ways I can do it. Silver has a lot of potential upside here. It's been a little bit of a laggard. So if gold runs away, I can always try to jump in with silver. The miners, at a minimum, a bounce here to 23 seems like it's got to be in the cards. 22.5, 23 range seems like it should be in the cards unless this dollar yen gets really firm. And then if dollar yen gets really firm, the miners may just fall out of bed. There's not a lot of support levels left below. Same levels basically held 4 times here in the last year. If that doesn't hold, if that finally breaks through, that could trigger a lot of stops because a lot of people seem to be using this support level as a good entry point. So we get below 21. look out below. Could be a quick washout. That quick washout may be the best buying opportunity in the world, but we could drop 10% quickly as everybody just gets out of the miners. Same sort of idea with the junior miners. Junior miners have actually found a little bit better support here. They're not so close to the lows. But if gold miners drop, it seems like junior gold miners are going to get dragged down more because they should be lower or should get hit when miners are getting hit. These are the ones that are more leveraged. So the fact that gold has held up a little bit, maybe it's helping the juniors a little bit, but generally speaking, if gold starts coming down, it could get real nasty, real ugly for them. So looking then on the pullback, if GDX hits those stops, maybe I can get into GDXJ because it may not get to 30 until GDX has already broken through that key support level, in which case I can still try to catch that break by getting some GDXJ puts. And finally, I'm going to go into the oil names here. And I really think that oil is trying to tell us something today. So the euro looked like it was kind of going to fall out of bed last week, and it held up. As long as the euro trend is higher, oil should continue to see some firmness. The oil and the euro have a sort of a longer term correlation. Day to day, it may not hold. So my concern with the euro is mostly looking for that trend to flip, and it doesn't look like this trend is going to flip. It's either chop or bullish here. So it's either kind of in this range or it looks bullish because these moving averages are still forming support while the longer term moving averages are upward trending. And when I look at oil and key it off of USO here, that pullback with some of the liquidation that happened on the tariff announcements and Powell's testimony and everything got us down here. But right now we're back above all the moving averages. The 10-day moving average is 12.5, and we're back above it today. So it looks like oil's trying to find another leg higher here, just like the rest of the market. I mean, oil is kind of trading with the equities, let's be frank. Where that gives me an opportunity, though, is that the oil names are dirt cheap off of that liquidation. So XLE at $68, it's dirt cheap. 77 before all this liquidation happened. At a minimum, it seems like we got to get back up towards 72. And of course, OIH. OIH has the same sort of setup. A nice big pullback. I mean, why wouldn't this go back up towards 27, 28? So then for me, it's all about just finding the cheapest way to lever that kind of move. And when I look at XLE vol, it's kind of expensive here at 20%. Realized vol has been around a little higher than that, around 21. OIH historically, 31's cheap, 30 is cheaper than the vol and XLE, but the realized vol has been a little bit lower, around 29. If I want to get into something that's got more time, I'm looking OIH. If I'm looking for something with a little more gamma, maybe XLE. So I'll just talk about the OIH one right now. So I'm looking at this April stuff. I can get under 30 vol here on the 27 calls. Probability is not as good with the 17 delta option. So maybe it's the 26s here. If we recover all the way to $28, these are worth $2. So that's a pretty good R&R, and I get a whole month and a half to let this trade play out. So April 26 calls for 44 cents look pretty cheap and like a pretty interesting way to get some leverage here if this is the bottom in oil. I'm going to keep watching USO for the rest of the day and into tomorrow and Wednesday because it really needs to continue to see firmness in equity markets to hold up. But as long as that holds, I think these names have a lot of potential for leverage here. So OIH and XLE are both pretty exciting to me, and that's why I'm looking for outright calls there in particular. So, all right, folks, that's it for today on the free stuff. Premium newsletter will be out soon. That is free if you want to sign up for the trial. So you can check out a month of the premium content for free. I get the newsletter, comes out with ideas and all of the stuff that I've talked about instead of just a couple of sample ideas in some of these options. And a lot of them are more complex structures that actually have really nice risk-reward profiles. I also do a Wednesday update where, for example, this last Wednesday I was talking about how the market's kind of turning into a trading market. And we will see now how it trades out of here. But right now I'm starting to move out of the trading market and back into the bullish market. So when, if we get back into a different spot, maybe it becomes a trading market again. we'll see how it goes. Go to tradeacademy.co/Harwood Report if you're interested and want to sign up. I hope to see a few of you guys sign up today. And again, first month's free, so give it a go. You can always email me, keith@tradeacademy.co, or call me 312-600-8004 as well. Thanks again, folks, and I hope to see you all in the premium newsletter later today.